It can be really tricky to decide which property to buy. Like, obviously, in the last 12 months, there was over 250,000 property sales in Australia. We've got a marketplace with unlimited options. In this video, I'm going to talk about how you can decide which state to buy, which market, which pocket of that state, which particular suburb, and how you can apply the fundamental rules of investing in property to your advantage so that over the next 5, 10, 15, 20 years, you can safely, confidently apply a low-risk approach to investing and hopefully use property to your advantage to create a passive income stream for your life and your family so you have better choices in your future. G'day guys, my name's Ben Everingham. I'm the director here at Pumped on Property. Now, if you haven't subscribed to our YouTube channel, stop what you're doing, subscribe now so that you can get these types of updates delivered straight to you each week as we release these videos. Now, I wanted to talk about a few things today. The first thing is that most Australian investors and most Australians that buy homes make one major mistake at the start of their property investment journey, and that is buying close to where they live because it's comfortable and it's safe, and jumping on realestate.com or domain before they even know what the hell they're looking for. Just jumping straight onto a suburb, looking at properties and believing that that represents a good analysis of the market and they've got their finger on the pulse. And I think the first thing we need to recognize is there are heaps of different options in the Australian property market. You could buy a capital city, you could buy a regional marketplace, you could buy a cheap property or a really expensive property. You could, buy a single income home or a dual income. You could buy a house, a townhouse or a unit. You could flip properties and try and make a profit. You could develop duplexes or triplexes or do subdivisions or bigger estates. You could renovate properties, add bedrooms, bathrooms. You could just buy really high quality stock. You could build a single income home or a dual income home. And for me, that is just so overwhelming. Not only are you trying to figure out where to buy, but you've also got to decide what to buy. So at the end of this video, I'm going to talk specifically to that. Now, if you're sitting on the fence and you don't know where you're at right now, I'd like to offer you a one-on-one strategy session. Just jump over to www.pumpedonproperty.com and we can talk about where you are right now and where you'd like to be in the future. We can talk about different options and the Australian property market, and you can start to educate yourself on a much deeper level. But the next thing that I like to do, or the first thing I do before I even think about property, is I get a strategy and plan in place for me. Now, there's some questions that you can ask yourself to help you figure out what your strategy is. For example, are you a high risk or a low risk investor? Are you looking for short-term or long-term gains? Are you looking to buy houses or units, regional or metro? Are you looking to buy an existing home or build a brand new one, single income or dual income? Do you have a great team of advisors in place, or do you need to build one? What are you looking to achieve? Are you looking to continue to work in the job that you may or may not like and have the current choices that you have in your life financially? Or are you looking to slowly and safely over time replace your income through property or businesses or shares or whatever it is that you want to do, and really put yourself in a position where you have financial freedom to do what it is that you want to do? And by slowly working through some of those different questions, you can start to craft a strategy that works for you. And I'll talk about some of these rules now. Now, for me, based on my analysis of the European, American and Australian markets over the last couple of hundred years, using books like Mastering the Australian Housing Market, Phil Anderson's book The Secret Life of Real Estate and Banking, which looks at 250 years of booms and busts in America from a property perspective, or Fred Harrison's books The Power and the Land or Boom Bust, which predicted the 1990s as well as the 2007 financial crises that we went through well before they happened, has given me this understanding that there's particular times in the cycle that represent good buying opportunities and times in the cycle where you want to stay the hell away from different asset classes. So understanding timing is important. Another rule that I have based on CoreLogic's research is I like to buy well-located houses, because if we look at houses versus units in the Australian market over the last 20 to 25 years, we can see that houses have outperformed units by over 80%. Now, another rule that I have is I like to buy metro markets, and in particular, I like to buy Sydney, Melbourne, and Brisbane at the right times of their cycles. Now, I don't go out and buy Sydney when it's declining in value. I don't go out and buy Sydney or Melbourne when it's grown by 60 to 80% in 5 years. I strategically buy Sydney at the right time of the cycle, which would have been well back in 2012, 2011 when I was buying that market. I strategically sold out of that market in 2016 and 17 because it wasn't difficult to see the writing on the wall of what was going to happen if you understand your history. Now, the reason I like metro markets is because according to CoreLogic, again, over the last 20 to 25 years, the metro markets in Australia have outperformed the regional markets by over 90%. Now, if you're leaving that 80% on the table by buying a unit, on average, obviously some areas with units perform well, and same on average with buying your metro market versus your regional, that's just such big gains that you're leaving in terms of your future gains on the properties you buy for yourself and your family. And that's the difference between getting financially free in a 15 to 20 year period and getting financially free over an entire working life. Now, in terms of the current timing of the cycle right now, there's some positives and negatives. It's certainly a negative time to be looking at Sydney or Melbourne. We are not at the bottom yet. There's still going to be a bit of a bleed or some pain before we begin to hit a bottom and things start balancing out again. Different people and analysts that I follow are expecting the Sydney and Melbourne markets to decline by another 6 to 10% at least this year. That's unfortunate if you bought property there in the last few years, but if you bought it 5, 10, 15 years ago, then you've got to look at your average long-term outcome and not get too caught up on this short-term dip that we're in at the moment, which, you know, understandably needed to happen because things were way too expensive and too much speculation occurred at the top, which is now why things are readjusting now, which is great. Some of the other negatives in the current property market, it's an election year in 2019, which scares some people off. Sentiment's not good, and money has been really, really difficult to access in Australia for the last 2 years, which is why we are now in this position that we are, where prices of properties around Australia have come to a halt, and in some instances even gone backwards in quite a big way. Now, in terms of how to decide, I'm now going to break it down to markets, pockets or areas, streets, as well as the right suburbs, so that you, regardless of where you want to invest in Australia, can make a smarter, lower risk approach to getting into your marketplace. Now, I have a just a crazy, I suppose, approach to investing, and that is I just think logically about what it is that I want to do. Now, if everyone made logical decisions, they would use timing to their advantage, they'd look at the history, they would buy properties with potential for long-term growth as well as cash flow, they'd buy properties with some upside. But unfortunately, most people don't use logic and don't spend that amount of time or don't have enough time to focus on the things that truly matter. So in terms of the market, you can start with Heron Todd White's month in review report, where you can get a really nice understanding of where the Australian property clock's at, where Sydney's at, where Melbourne's at, Perth, Darwin, Canberra, Brisbane, Hobart, Wollongong, Newcastle, Sunny Coast, Goldie, and within an hour of reading that report, you would have a really deep understanding of where things sit right now. Now, obviously take that with a grain of salt because no one has a crystal ball and nobody can see where things are going directly. But longer term, if you apply your history, you might be able to make a better decision. Now, there is no Australian property market. If property prices in Australia decline by 5% this year, some suburbs in Australia will decline by 25%, others will increase by 25%. Some markets like Sydney might show an overall decline this year of 10% citywide, but some suburbs will break even, some suburbs will even increase in value. Same with Melbourne, same with Brisbane. So averages are really dangerous, and I was talking to one of my clients, Chris, last night, and he's did a maths degree as well as a master's or postgrad in statistics, and we're just laughing at how incorrectly quoted most averages actually are and how it's not a true representation of what's going on in the broader market. In terms of the markets that look interesting according to Heron Todd White for this stage, Brisbane is at the start of the recovery, which is a nice phase to buy. Sydney's in the decline, so is Melbourne, so is Newcastle, so is Wollongong. So is Perth, Darwin is there as well. So you've got to start educating yourself. Sunshine Coast, for example, is at approaching peak of market. Gold Coast is now in the start of the declining phase, and by understanding these things, you can then go, okay, I want to buy not at the top where, you know, the market's gone through a huge growth phase in the last 7 or 8 years. I want to be looking at marketplaces that haven't gone through that growth yet, so that I can strategically time them and ride that wave as they go up over the next X amount of years. But no one knows what's going to happen in 12 to 18 months or 24 months. So don't expect too much from anywhere you buy in Australia over that period. In fact, expect a decline, and then you won't be sad if you get one. And if it does better than that, then you might be happy with that. In terms of the market then, let's say you've gone, I only invest in metro property. You know, right now I'm looking at Brisbane. Obviously Brisbane isn't just one area. Brisbane is north, south, east, west, and the city. You know, I avoid south and west Brisbane because of the demographics down there and just the huge amount of investors that funneled into there in recent years. I personally like East Brisbane and North Brisbane the same as I like North, South and East Sydney, and I like Eastern Melbourne. You know, I want to be investing, because I'm only going to buy a very small number of properties over my lifetime, in the area that has the higher incomes, the lower vacancy rates, the families living there, and the smallest percentage of investors investing in those markets as possible, because I'm looking for long-term areas that represent great quality value. Now, when it comes down to the pocket, let's say you've identified East Brisbane, for example, as the area you're going to focus on. From there, then, there's a huge amount of suburbs within that. You know, my rule of thumb there is, according to Michael Matusik's data, buying within 20 k's of Sydney, Melbourne, Perth, Canberra, Adelaide has historically performed better over the last 10 years than buying further away from the city. So I like to follow that rule. I like to buy as close as I can afford. And if I'm not buying that close in a regional market like the Sunshine Coast, then I want to be walking distance to the beach, because we know that long-term property prices in the beachside suburbs around Australia have outperformed areas that are a little bit further away from the beach. And that's just simple. They're not creating any more waterfront land, and wealthy people congregate in those areas because of the lifestyle benefits associated with it. People pay a premium for the rents in those areas, again, because of the lifestyle benefit of being there. So once you've identified the right pocket, then you start to look at the indicators within each of the suburbs, like DSR scores, walk scores, historical growth rates, average auction clearance rates, and then I reduce it a lot further, like average time on market, which gives me an idea of supply and demand, the average vendor discounting, which gives me an indication of how much below the price on realestate.com I could really buy for, vacancy rates. You know, I look at what the average incomes are in the suburbs, how many people are renting versus owner occupying. I look at the history of all the sales in the suburb, and that, you know, enables me to have a bit of a format or a template that I can use to compare 3 or 4 different suburbs together to identify which one suburb I'm going to focus on. Because that's another huge trap that most people in this current market are making, and a mistake, and that is they're looking at everything when in reality they should just be looking at one market, one pocket, one particular suburb, and they should be an absolute specialist in that area before they even think about jumping on something like realestate.com and deciding if, you know, properties in that suburb actually represent value for them as well. A lot of people also don't have a plan in place before they actually get started, which means that anything could potentially look good and they could get swayed this way or that way. Where for me, I've got such a big checklist of things that I look for myself and for clients when I'm looking to buy, that it stops me making some of those big mistakes that I've made in the past. And those things could be as simple as, you know, getting a Google map printed out and then mapping the most expensive, the middle and the cheaper sales, and trying to buy in the middle and premium pockets of a suburb. You know, looking at things like that most people don't look at, like flood searches, bushfire searches, you know, what type of product I can create in that area based on the planning policy, where housing commission is, where the high percentages of renters are, where the high percentages of owner occupiers are, so that within the suburb I can narrow it down to some streets that actually make sense to me personally. Now, the last thing I wanted to touch on in this video is property is actually super simple. Now, I know I've gone through a lot in this video because I really want to help you decide or begin to understand how to break down which property to buy or which suburb or which market to consider this year or next year. But property is simple, right? Like, this is my personal strategy for investing, and take it with a grain of salt because there's 1,000 different ways of doing it. I like to time the market because I know if I time the market, it reduces my risk. I take an extremely low risk approach to investing. I like to buy houses because history shows me, according to CoreLogic, they've performed better. Same with metro, because history shows me that the metro markets have outperformed the regional areas. I also like Sydney, Melbourne and Brisbane more than other areas because, according to Michael Matusik and the Australian Bureau of Stats, they're the areas that are going to pick up 75% of Australia's jobs, infrastructure and population growth over the next 10 years. And I don't want to roll the dice on an area that, you know, I'm unsure about. I also like to buy, you know, close to the city within 20 Ks. I like to buy properties with great long-term potential for growth, but also really good cash flow. So that means, you know, good quality houses with a granny flat these days. And for those of you who are concerned that do granny flats cost you long-term capital gains, a client of ours, Dave, who actually did this strategy 15, 20 years ago in Sydney, he just bought $300,000 and $400,000 homes. Then he built granny flats on them for about another $120,000 at that time. Has now had those properties, after a full 15 to 20 years in the marketplace, be revalued at $1.1 to $1.3 million, and the rents are now over $1,000 per week. Now, he's got 3 of them there, and then we helped him do 1 of them in Brisbane. Dave is in a position where he's effectively financially free from what he's done. And I asked him one question, which is a common one I get around dual income or house and granny flat or brand new with a granny flat, and that is, has it affected your long-term performance? And he said, absolutely not. Whatever the average growth rates in the suburb has been, whether it's going up or declining year on year for the last 15 to 20 years, his properties have gone up in line with those values, and obviously the valuations have improved as well as the cash flow position on those properties too. So I buy for cash flow. Because I'm a bit more of an active investor and my wife's an interior designer, I do like to try and make something on the way in from buying well, and I like to buy something that I can, you know, maybe renovate a little bit in 5 years' time, maybe add a granny flat too when I'm ready to, or maybe buy a piece of land below market value and then build below market value as well. So property doesn't have to be this complicated beast that freaks you out and, you know, keeps you paralyzed. You know, the media doesn't have to be this scary thing. Borrowing money is a lot easier right now than it has been at any other point in the last few years. You know, in terms of timing a market, you really want to be buying when everybody else is scared, but using your history to underpin the confidence associated with that buy. And obviously not doing something stupid. If I'm telling you that Sydney and Melbourne, according to the most sophisticated analysts in Australia, is going to decline in value by 6 to 10% this year, then obviously this isn't the year to go and buy those markets. But for somewhere like Brisbane, where the analysts are saying that, you know, things over the next 7 years could look a little bit better than they have in the last 7, maybe, who knows, they don't know. And that maybe, according to CoreLogic, Brisbane is now more affordable to buy in 2019 when you factor in inflation than it was in 2008. But long term it's performed as well as Sydney and Melbourne in the last 48 years. Then you can start to make better quality decisions around where it is that you're looking at and what it is that you're looking to buy. But this is an exciting couple of years. It's also a dangerous couple of years for uneducated punters without a good strategy in place. You know, take the time to educate yourself. Check out those CoreLogic updates, the Heron Todd White updates. You know, talk to your accountant and a financial advisor, or, you know, people in the property industry to start educating yourself on what's going on. Take all of their different ideas that are on their podcasts and videos, and, you know, start to formulate something that works for you and your family. Because the last thing I wanted to say is that most people get emotionally tied to what they're buying. They buy at the wrong time, they buy close to home, they buy assets that cost them money every week. You can do that, or you can start to educate yourself or find a partner that can help you make high quality, better decisions based on their experiences as well. But it doesn't have to be scary. You know, take a low risk approach to this sort of stuff. Take a longer term approach. What I've learned is it's not going to happen as quickly as you expect it will, but if you're consistent and diligent over time, it can. So I'd love the opportunity to offer you a one-on-one strategy session. Please jump over to www.pumkedonproperty.com, book a time with me or my brother Simon. Let's get honest. Let's talk about where you are and where you want to be, and let's get real about what's holding you back, because if you're not already financially free and you don't already have choices in your life, then something is stopping you. Generally it's between here and here, or in here, or even in your tummy, or it might just not be the right time for you and you need to get educated and get yourself a good plan in place before you have the confidence to take action. But if you're thinking about buying in the next few years, jump to www.pumkedonproperty.com. Let's have an honest conversation. And if you haven't already, please subscribe to the channel. Check out our podcast. It's so different than this format of videos. It's much more relaxed. It's much more talking about what's going on in my world. It's talking about things like health, as well as property and family and choices and financial freedom and the market and just what's going on in my world. I have guests on that podcast all the time, including my brother, my business partners and others, clients too. I wish you all the best for the next couple of years. It's an exciting time. It's going to be a scary time. It's going to be a time when some people lose money. It's going to be a time when some people use this environment to set their futures up and buy when others are scared. But whatever you do, make sure you don't overdo it. Make sure you don't overexpose yourself or your family, and just get educated before you take action. So I wish you all the best. Good luck with your journey, and good luck over the next few years.